Brian Hicks is out with a new energy stock and claims it can 5x, 10x, or even 20x. I reveal it here for free so you don't have to buy Brian's newsletter. No paid or proprietary information is given away here. This is simply guesswork based on clues from a public presentation. There's more than one stock to reveal, so we're just going to jump into things. Here's how the presentation starts out. Buried, banned, now booming. The Black Fuel Rebellion. Trump's $12 trillion comeback starts here. Coal was canceled. Now it's king. It built America's empire once, and now it's back to build the next one. An empire of silicon, data, and raw digital horsepower. And the tiny company behind it? They've just struck a billion-ton jackpot, and early investors are already cashing checks. According to Hicks, Trump is bringing back coal to power hyperscale data centers, the new digital factories of America, to bring tech giants back from China and into the Rust Belt, to fund a sovereign wealth fund that could send mailbox money to every U.S. citizen. And Hicks is pitching a particular coal company to benefit from this and leaves plenty of clues to figure it out. He says, at the center of it all is a tiny coal company most Americans have never heard of, but they control a billion-ton deposit right in Trump's new energy corridor. They've got the reserves, they've got the permits, and now they've got the spotlight. And later he says this about this company. This company is already firing on all cylinders, 100% American-owned, fully operational, and delivering real megawatts to AI infrastructure from U.S. soil. It's not a moonshot startup. It's a proven energy powerhouse with a 20-year track record and $4.4 billion already paid to investors. Here's what makes it unstoppable. 7 active mining complexes, 33 million tons sold annually, 78% of next year's production already pre-sold. It's locking in long-term contracts, pumping out nearly $500 million in free cash flow. And then he says, Goldman Sachs grabbed a $16.3 million stake. JP Morgan upped its position to $47 million. And finally, they have an 11% dividend. The company being pitched here is Alliance Resource Partners, ticker ARLP. Alliance Resource Partners, LP, is a diversified natural resource and energy company headquartered in Tulsa, Oklahoma. It's best known as the second largest coal producer in the eastern United States, operating multiple underground mining complexes across states like Kentucky, Illinois, Indiana, West Virginia, and Maryland. These mines primarily supply electric utilities and industrial customers. In addition to coal production, the company has a significant portfolio of mineral and royalty interests, including oil and gas properties. This allows them to generate income from third-party drilling activity on lands where they hold mineral rights. Their royalty portfolio covers approximately 70,000 net mineral acres across key basins. Here's the top 5 things to know about this stock, and after I'll tell you if I'd buy. First is dividend darling or dividend trap. Alliance Resource Partners offers an eye-catching 10.8% dividend yield with a consistent 0.70 quarterly distribution. The company has maintained this payment level through recent challenging periods, demonstrating management's commitment to shareholder returns. However, this high yield reflects market skepticism about sustainability in a declining coal industry. The company's strong balance sheet, 0.76x debt to earnings before interest, taxes, depreciation, and amortization ratio, and $514.3 million in liquidity provide near-term dividend coverage, but long-term sustainability depends on successful diversification away from coal. Income-focused investors should weigh the attractive current yield against potential future cuts as the coal industry continues its structural decline. Second is financial fortress under siege. ARLP boasts impressive financial metrics that would make many companies envious: low leverage, strong liquidity, and disciplined capital allocation. The company ended Q1 2025 with total debt of just $484.1 million and maintains excellent access to capital markets. However, these strengths are being tested by declining revenues. Q1 2025 revenue fell 17.1% year over year to $540.5 million, and compressed margins. Net income dropped from $158.1 million in Q1 2024 to $74.0 million in Q1 2025. While the balance sheet provides a buffer, investors must consider whether financial strength can offset fundamental business headwinds. The company's conservative financial management is a clear positive, but it may not be enough to overcome industry-wide challenges. Third is diversification dreams versus coal reality. Management is actively pursuing diversification through oil and gas royalties and other energy investments, which showed 18.7% growth in Q1 2025. This strategy demonstrates forward-thinking leadership recognizing coal's limitations. The company has also invested in digital assets and continues exploring new energy opportunities. However, coal operations still dominate the business, generating the vast majority of revenues and cash flows. The diversification efforts, while promising, remain relatively small compared to the core coal business. Investors should view this as a long-term transition story rather than a near-term solution. Success will depend on management's ability to accelerate diversification while maintaining profitability in coal operations during the transition. Fourth is political wins versus ESG storms. The Trump administration's pro-coal stance provides significant short-term tailwinds, with executive orders promoting coal-fired generation and grid reliability. The White House forecasts 16% electricity demand growth over 5 years, potentially benefiting coal producers. ARLP has secured 17.7 million tons of new contract commitments through 2028, with 96% of 2025 volumes already contracted. However, these political benefits face powerful ESG headwinds as institutional investors increasingly avoid coal investments. Many pension funds, endowments, and ESG-focused funds have divested from coal companies, limiting the investor base and potentially depressing valuations. The tension between short-term political support and long-term environmental pressures creates significant uncertainty for investors. And last is operational excellence in a sunset industry. ARLP stands out as one of the best managed companies in the coal sector, with experienced leadership under CEO Joseph Kraft's 25-year tenure. The company operates as the second largest coal producer in the eastern U.S. with high-quality reserves and efficient operations. Recent operational improvements include cost reductions in the Illinois Basin and strong contract coverage providing revenue visibility. The company's focus on premium thermal and metallurgical coal markets offers better pricing power than lower-grade competitors. However, even excellent operations cannot fully overcome industry fundamentals, including competition from cheaper natural gas, renewable energy growth, and utility coal plant retirements. Investors must decide whether operational excellence can generate sufficient returns in a structurally declining market. ARLP surged about 600% from 2020 to 2022 and has been pretty much flat since then. If investors realistically thought this company was going to power data centers, I think the stock would have gained a little in the last couple of years. Its valuation is great by traditional metrics, but there's no growth here. If you want a high dividend, this stock could work for you, but I don't see the stock price exploding like it did from 2020 to 2022. Hicks is also pitching a bonus stock titled Trump's $500 billion gold play, the tiny miner set to 10x in the new gold rush. Here's what he says about this stock. Trump's executive orders go far beyond coal, oil, and gas. They've triggered a full-scale mineral awakening, unleashing over $12 trillion in buried American wealth, including massive untapped reserves of gold. And now, one of the largest gold deposits on Earth, hidden for decades beneath Alaskan soil, is finally being unlocked. It all began on March 20th, 2025, when Trump signed what may go down as the most profitable executive order in U.S. history, activating the Defense Production Act, opening access to 640 million acres of federal land, and fast-tracking mining permits to ignite a once-in-a-century American gold rush. This is Northern Dynasty Minerals, which is a stock we've covered on this channel before. Northern Dynasty Minerals is a Canadian mining company focused on developing the Pebble Project, a large undeveloped copper, gold, and molybdenum deposit located in southwest Alaska. The project has faced significant environmental and political opposition due to its proximity to the ecologically sensitive Bristol Bay watershed, which supports one of the world's most productive salmon fisheries. Despite this, the company continues to pursue permitting and legal avenues to advance the project. Here are the top 5 things to know about this stock. First is gargantuan resource with long-term potential. Northern Dynasty owns the Pebble Project in southwest Alaska, one of the world's largest undeveloped copper-gold molybdenum deposits. With measured and indicated resources containing tens of billions of pounds of copper and millions of ounces of gold and silver, the project's scale positions it as a strategic asset amid rising demand for green metals. Second is permitting paralysis and persistent legal battles. Despite its raw potential, Pebble has been mired in regulatory hang-ups for over a decade. The EPA issued a sweeping veto in January 2023, halting discharge permits under the Clean Water Act and sparking ongoing lawsuits from both NAK and the state of Alaska. The company has repeatedly agreed to litigation delays and abeyances through mid-2025, but progress remains uncertain. Third is capital raises and royalty windfalls. NAK isn't idle during delays. It has actively raised funds through convertible notes and placements, and has received royalty payments totaling $12 million for a tranche linked to project advancement. While this helps with cash runway, these are stopgap measures rather than full project financing. Fourth is environmental safeguards or red flags. The company highlights plans for advanced tailings management, including lined containment and backfilling to prevent acid drainage upon closure. However, critics and Alaska Native groups argue that no engineering can fully protect Bristol Bay's sensitive salmon ecosystem, underscoring a fundamental tension between development and environmental preservation. Fifth is market volatility and analyst sentiment. NAK trades around $1.33 per share and exhibits high volatility. Sharp drops like a recent 9% decline are often tied to regulatory or environmental headlines. Analysts remain divided. Some assign modest buy ratings and price targets near $1.30 Canadian cents, while others see ongoing litigation and uncertainty as major drawbacks. Northern Dynasty belongs on a watch list because they aren't even close to mining any gold yet. They don't have the permits to mine, and the EPA would have to reverse its decision to block mining in the Pebble project. I wouldn't talk someone out of a very small investment now as a gamble on them getting their permits. The stock tends to just follow the news. When they get good news, the price surges. When they get bad news, it crashes. But keep in mind, miners have been trying to mine this ground for decades, and no one has been able to do it. If Northern Dynasty can pull it off, the stock will skyrocket, but the odds aren't in their favor. And don't forget to click the link in the description to check out AlphaPick. Right now, they're running their biggest sale of all time, and you can get $100 off this amazing service. Remember, I've reviewed over 100 stock picking services, and this is the only one that consistently beats the market, nearly tripling the returns of the S&P since inception. So again, make sure to click the link in the description and get $100 off this incredible deal.